Most people think power shifts happen with announcements, press conferences, flashing headlines, but the biggest shifts never look dramatic in real time. They happen quietly, wrapped in technical language, buried inside filings, settlements, and routine, market actions that almost nobody reads. And that's exactly how this unfolded. What we're witnessing isn't a sudden takeover. It's the final stage of a process that's been building for years, where control over something real, tangible, and finite slowly moved from an open market into the hands of a single dominant force. Silver isn't just another commodity. It's money with a long memory. It's been used as currency, as a store of value, and as a strategic resource long before modern financial systems existed. Unlike paper assets, it can't be printed. Unlike digital numbers, it doesn't disappear when confidence collapses. And that's why control over silver matters so much, especially at a time when trust in financial systems is already stretched thin. Whoever controls the flow, pricing, and accessibility of silver doesn't just influence a market, they influence confidence itself. For years, people were told that silver prices were set by free markets, buyers and sellers meeting transparently, supply and demand doing the work. But behind that story, something else was happening. Positions were being built, warehouses were being filled, paper claims multiplied far beyond the physical metal backing them, and slowly, quietly, leverage replaced transparency. What looked like liquidity was often just promises stacked on promises, all resting on the assumption that no one would ever demand the real thing at scale. This is how power consolidates in modern finance, not by banning ownership outright, not by confiscation in the traditional sense, but by controlling the plumbing of the system. When one entity becomes central to clearing, settlement, storage, and pricing mechanisms, it doesn't need to announce dominance. It simply becomes unavoidable. Everyone else must operate through it, around it, or under its terms. And once that happens, the market stops being a market and starts being a managed environment. What makes this moment different is timing. This consolidation didn't happen during stability. It happened as cracks were already forming elsewhere. Debt levels are extreme. Confidence in currencies is fragile. Supply chains are vulnerable. In moments like these, real assets matter more, not less. And silver sits at a dangerous intersection. It's both an industrial necessity and a monetary hedge. Control over it means influence over manufacturing, energy systems, technology, and investment behavior all at once. Think about what that means in practical terms. When price discovery is influenced by a concentrated position, prices no longer reflect scarcity, they reflect strategy. When access to physical supply runs through centralized channels, availability becomes conditional. When paper contracts vastly exceed physical reality, stability depends on trust rather than substance. And trust, once shaken, doesn't come back easily. Many people assume that if something were truly wrong, regulators would step in loudly and clearly. But modern regulation often works differently. It formalizes outcomes after the fact. It blesses structures that already exist. It reframes concentration as systemic importance and dominance as market stability. And once that language is accepted, reversal becomes nearly impossible because disruption is framed as risk. This is why the shift feels invisible to most people. Prices may not explode overnight. Shelves don't empty immediately. Headlines don't scream collapse. Instead, the system keeps functioning until it doesn't. And when stress finally hits, the rules that were quietly put in place suddenly matter more than anything else. Who gets priority? Who settles in cash instead of metal? Who is told to wait? Those answers are determined long before the crisis begins. And here's the uncomfortable part. By the time the public fully understands what's happened, the leverage is already gone. Choice has already narrowed. Optionality has already been transferred upward. People look back and realize that the warning signs weren't dramatic. They were technical, boring, and easy to ignore. That's how modern financial power prefers it. This isn't about villains or heroes, it's about structure. It's about how financial systems evolve when scale replaces competition and efficiency replaces resilience. It's about how control today doesn't require ownership of everything, just ownership of the choke points. And silver, quietly and methodically, has been moved into one of those choke points. So when people ask why this matters, why anyone should care about positioning in a metal market, the answer is simple, because this is what happens right before scarcity becomes visible. This is what happens before rules change without asking permission. This is what happens before people realize that the market they thought they were participating in isn't the same one that actually exists anymore. What makes this moment so dangerous isn't just the concentration of power, it's the way that power is being legitimized. This isn't a chaotic grab. This isn't something happening outside the system. This is happening through the system. using its language, its rulings, its compliance frameworks, and its legal cover. And that's why so many people don't recognize what it really is. When asset seizure happens quietly through paperwork instead of force, most people don't realize anything has been taken until they try to access what they thought they owned. We've been conditioned to think of seizure as something obvious: police, tape, emergency orders, dramatic headlines. But modern financial seizure doesn't look like that. It looks like rule changes. It looks like risk management. It looks like settlements that don't reverse behavior but formalize it. Ownership isn't stripped away in one move. It's diluted, deferred, and redefined until control no longer sits where people assumed it did. You still hold a statement. You still see a balance. But what you can actually claim, convert, or receive has quietly changed. This is how ownership becomes theoretical. On paper, you're included. In practice, you're subordinated. When systems come under stress, priority matters more than participation. Contracts matter more than expectations, and rulings matter more than fairness. The framework being built right now doesn't protect equal access, it protects continuity for those deemed essential to the system. Everyone else is expected to accept cash, delays, or alternative resolutions and be grateful the system kept functioning at all. And notice the language used when this happens. It's never described as confiscation. It's described as stabilization. It's never framed as loss. It's framed as protection. The argument is always the same. Without this structure, everything would fall apart. And once that logic is accepted, anything becomes justifiable. Because now the question isn't who owns what. It's what must be done to preserve the system. And when preservation becomes the goal, individual claims stop being sacred. This is where the idea of asset seizure shifts from something illegal to something procedural. Control is exercised not by taking something away directly, but by changing the conditions under which it can be accessed. Settlement terms are modified, delivery options are restricted, physical claims are replaced with cash equivalents, and suddenly what you thought was a hard asset behaves exactly like a paper promise, valuable only as long as the system allows it to be. What's most unsettling is that all of this is happening in advance of a visible crisis. These structures aren't being built in response to panic. They're being put in place ahead of it. That tells you everything you need to know. You don't reinforce exits unless you expect pressure. You don't centralize control unless decentralization has become inconvenient. And you don't rewrite rules unless you know the old ones won't survive what's coming. People often ask, why would this be allowed? But that question assumes the system exists to protect participants equally. It doesn't. It exists to prevent collapse. And when those two goals conflict, collapse prevention wins every time. That's why legal rulings matter so much here. They don't just interpret law, they signal priorities. They tell markets who will be protected, who will be absorbed, and who will be left holding claims that look solid until the moment they're tested. This is the quiet transfer most people miss. Value doesn't disappear, it moves. Risk doesn't vanish, it's reassigned. And the public doesn't lose everything at once, it loses leverage first. The ability to choose how, when, and in what form assets are realized is slowly taken away. And once that leverage is gone, the rest follows naturally. Think about how different this feels from traditional loss. There's no single moment to point to, no clear theft, just a growing realization that the rules you planned around no longer apply, that what you believed you owned can no longer be accessed on your terms, that the system you trusted has priorities you were never part of. And by the time that realization fully lands, every legal pathway has already been closed. This is why calling it a ruling misses the point. It's a line in the sand. It's a declaration of how future stress will be handled. It tells you who stands at the center of the system and who exists at ITS edges. And once those lines are drawn, they don't move in favor of the public. They move in favor of stability as defined from the top down. So when people say nothing has been taken yet, they're technically right, but they're missing what's already happened. Control has shifted, optionality has narrowed, and ownership has been reinterpreted. That's how modern asset seizure works, not by force, but by framework.